Today is Tuesday, the 11th of January, 2022. Time flies. I remember the year 2000. I was sitting outside my porch right there in Logan Heights, staring up at the sky, counting down to midnight, and then you just like, okay, the world's about to end right now. I still remember that. Just like, okay, the world's gonna end. I'm looking for like a flying star or meteor or something. And that was 22 years ago. That's wild. I'm really excited about tonight. There's a lot of you guys on here, and we all have one common goal, and that's to make money, right? That's why we're on here. Is we want to know what happened in 2022, a recap there, and then we want to know what we should be doing in 2022. So I see a lot of you guys on here. If you're in appropriate setting, turn on your cameras. We want to see your face. We want to be able to, see your guys's beautiful eyes. 2022. I promised myself I'd be more kind. So there you go. There's some compliments to y'all. I'm really excited about today. We have a lot of good stuff. We have a really, really good panel. We're going to be talking about things that are very important. And that's our finances, that's our money, that's our real estate. That's the stock market, the economy, taxes. We're going to be talking about taxes. So why are we doing this? Well, I mentioned in one of my videos before that, I've been in real estate since 2002. I wish I would have studied more. I wish I would have really taken the time to educate myself and use the knowledge of other people, such as Roberto Kelly, such as Dr. David Fogel, Jesse, Ajay, everyone who's going to be on today's call, like professionals, basically reaching out to professionals and saying, hey, tell me what's going on in your world. Tell me what you know, because you've been in this a long time, and reading articles. And I didn't do that. And therefore, some of the best years to invest in real estate, I lost. And I didn't invest in real estate just because I wasn't aware. I was scared. I didn't know what was going to, what to do or why to do anything at all, make any moves. So I just kind of just didn't do anything. And it cost me millions and millions of dollars. Luckily for me, I snapped out of it, educated myself a bit, and I didn't even know the whole story, but I just figured real estate was good, and I started buying real estate, and the rest is history there. So we have a really good lineup. First off, let me just kind of share with you the outline that we have right here. And cool. So this is the lineup that we have. We have Robert Kelly, mortgage broker. He's going to be kicking it off, talking about mortgages. Then we have Ajay Gupta, attorney. He's going to be talking about real estate laws and things that we should know in real estate, and also bankruptcy, because it's important to know, hey, what's going on with bankruptcies? Are they up? Are they down? What's going on with people's finances right now? And then we have Dr. David Fogel. He's going to be talking about breaking down technical analysis on the S&P 500 overall economy. That way we know, hey, what's been going on and what's going to happen in the future, hopefully, with some insight there. Then we have Abe Lopez. He's an architect slash designer, and he's going to be breaking down what's going on with construction, because he helps a lot of people build properties, and that's what's going to kind of give us an indication as to what to expect in the future with inventory and home prices. So that's going to educate us a lot. And then I'm going to finish it off with the real estate update and what I think is going to happen with the real estate market. So that's kind of what we got going on. At any point, you guys could go ahead and ask a question, because we want this to be interactive, and we want to know what you guys are wondering, and that way we could better answer that for you. So if you could do that for us, we definitely appreciate it. And just ask questions. Don't be shy. Go ahead and either mute yourselves or just shoot it in the box, and then we'll mute you, and then you can ask the question. So that's what we're going to be covering. Okay. So our first guest, Roberto Kelly, he is a good friend, longtime friend. He has a bachelor's of science in financial administration. This summer, he's going to be 20 years in the industry, and he's closed approximately 1,000 loans in his career. He works with American Financial Network, and he does loans nationwide, except in North Dakota and South Dakota. And so welcome, Roberto. I know you're in Mexico City right now doing some business out there. You can unmute yourself, sir. We can't hear you yet. There you go.
Hi.
Hello.
Good evening.
Good evening.
Hello, everyone.
Hey, what's up? All right. So I have your presentation. If you want, I'll share it. Is that cool?
I'll go ahead and share because I made a small update.
Cool. So let's give you co-host there. So you should be a co-host now.
There you go. Perfect. Okay, so I'm going to take over. Hi, everyone. Thank you, Team Lepe, Tendwell, for having me for the second year in a row. I'm going to do a brief market analysis of what's happened in the last year and what is going to happen this year based on the specific markers that we're seeing, how rates are moving, what programs are coming in, what's gonna be a trend in the market for 2022 and beyond. I will keep it short. If you have any questions, please feel free to ask at the end, preferably. So can you guys see my screen now?
Yes.
Yeah,
Okay.
we can see your screen. And if you have questions, just throw it in the chat and then we'll just get to it at the end. So that way you won't forget. So go ahead and ask any question you want in the chat. That's cool.
You got it. Okay. So as Voltaire mentioned earlier, I lead the Kelly Mortgage Group. We were here in San Diego, and we have the ability to lend nationwide. Okay, so this is what happened in 2021 to rates. As you guys can see, if we just focus on January for now, you're going to see that that 2019 was the highest point in rates in January. Why am I focusing in January? Is because normally the trend normally starts at the beginning of the year, whether it's upwards or downwards. So in this case, you'll see that potentially the lowest rates ever. This is for a 30-year fix, by the way, and this is obtained from the Freddie Mac website directly. We were looking at 2.74, essentially a 2.875, 2.75% rates January of last year. If we jump into January of this year, rates have moved up between 0.5 point and a point across different loan programs. Now, take in consideration that this is for single family residence, primary, meaning it's owner occupied. So what was seen last year in 2021 for rates, it's not expected to remain the same in 2022. As I mentioned, rates have already moved up. They actually moved up along with the 10-year treasury yield at the beginning of the year, or let's say last day of last year. So magically, last day of last year, it went up and rates followed as a consequence. So most agencies, Freddie Mac, Fannie Mae, and the Mortgage Bankers Association and other associations, they've all estimated the rates were going to go up in 2022. We just didn't expect for them to move up so quickly, so soon. So rates have gone up. We're going to go over commentary about that shortly. Okay, so what it is that we expect rates-wise. So we expect for rates to be oscillating between 3.3 and 4% throughout the year. As you guys probably saw in the previous table, pricing has been kind of erratic, so rates move up and down, and they sometimes do it aggressively. So you need to make sure that whenever you're going through a transaction, if you have the ability to lock in the lower range that I'm giving you right now, make sure you do it from the get-go. Many clients from many banks suffered, as a result of getting into escrow in December and not locking their rates when they had opportunities, and now those opportunities are gone. Rates are still very low. So let's make that clear. Rates are very low. Even if they're in the mid threes, high threes, low fours, historically they're still very low.
Yeah, just go
So
back to that last slide, Robert, so we could just see again real quick. So, I mean, 2018, there were 4% throughout the entire year. 2019, they're
yeah,
basically 4%.
I mean, they were almost 5% at some point in 2018, and this is for a 30-year fix again, a primary, residence. If we go into investment loans, rates were significantly higher. They were in the mid fives, high fives.
But this is like you live in this home, it's your primary. I mean, you're getting a really good rate, and they barely
Yeah,
dropped under 3% for the
yeah,
first time, a couple of years ago. So never in
right.
history has that happened, right?
They've been low in the past, in the early 2000s, when they were trying to speed up the economy. They dropped rates to inject more liquidity into the markets. However, what we've seen in 2021, I just personally, since 2002, I do not recall 30-year fixes being that low. No.
Right. Yeah.
Okay, which was another factor, that also accelerated prices last year when everybody thought they were going to stop going up, right? So it was the opposite. They went up even more aggressively, and rates remained very low. And I'm going to touch on a very important point on that subject shortly. So one of the most important factors here that mostly nobody talks about is that inflation, according to the federal government, we ended up, I think we closed the year with 6.2%, which that's the federal government's number, right? There's other numbers out there that are significantly higher than that. So think about the following. You have a rate still, even with rates going up right now, you have a rate in the threes, and inflation is in the 6% or higher, okay? So essentially you're borrowing money below inflation. So just by borrowing money below that inflation rate, you're technically making money, okay? So I think in one of the conversations, Voltaire, that you and I had, we brought that up with a couple of clients, mainly because that's a way to invest money. You invest money by obtaining a mortgage because you're getting money cheaper than than it's losing value. Okay, so just so that we leave that clear, rates are still very, very low.
Yeah. And just to touch on that, guys, if you could borrow money right now I mean, the way I look at it is simple, right? It's like, if you're on here, it's because you have some type of money mindset, right? You're thinking of, hey, I want to make some money. So if somebody hands you $1 million, they say, hey, just pay me back the $1 million, but you don't have to pay me back tomorrow. You have 30 years to pay me back. Number one, 30 years to pay me back the $1 million. Number two, you get to pay me back at 3% interest rate or 3.5% interest rate or 4% interest rate. If you have that money mindset, that little hustler mindset, that should be a slam dunk for you. You should say, yes, give me the $1 million, right, of today's money. And not only are you going to give me 30 years to pay back, but you're going to allow me pay you back with tomorrow's money, with money from 10 years from now, from 20 years from now, which we all know 20 years from now, $1 is going to be worth a lot less than it is today, right?
Yeah.
So
That's known as the time value of money. Essentially, because of inflation, every year your dollars are worth less. So think about this. If you have $1,000 right now and next year they're, worth 6% less, let's just use that number, that will be worth 940. However, you're only paying $30, $36 for interest. So you are making the difference. That is your profit, So, and most importantly, it's also when you're paying interest on a property, let's say an investment property or on your primary with some limitations, you write off that interest. So not only are you making money against inflation, but you are also writing off those monies in most cases.
Yeah,
Okay?
for sure. That's awesome. Okay.
Okay.
Roberto, talk a little bit about when we were talking the other week about you should be in the mortgage business, not the real estate business right now. I thought that was a fascinating concept.
Yeah, so that is essentially what we just said, just explained in a
Right.
different way.
Right,
Uh,
but it's a simpler way of explaining it.
Yeah. So essentially, when you're still buying real estate, but when you buy real estate, you're obtaining a mortgage and you're borrowing the money, as we mentioned, below inflationary rate. So you're technically investing in real estate, but you're investing in loans.
Yeah.
Okay.
So
That's
better, a easier way to say it is if you own a piece of real estate, you should have a mortgage on it for sure.
100%. Yes.
And it should be not as much as you can, but as much as it makes sense, meaning, where the payment's good enough, but you shouldn't have like 50% equity in your home or in your property.
Yeah. Yeah. Yeah.
You should have
Yeah.
a good loan on it for sure. Do not
in
pay it
many
off.
in many cases, Voltaire, what happens is that people that bought 2, 3, 4 years ago, they have so much equity that they've accumulated since, and they still have those old rates. They haven't refinanced. So many times you're able to pull money out, still have the same payment, but with the cash at hand that you can then invest properly and multiply it.
Right.
Okay. So now I'm going to go real quick to the next slide since we are running out of time. I just want to speak shortly about loan programs and loan limits. Essentially, what's happening is many programs that used to be around pre-2007, 2008, have made their way back into the market. So you see this when many of the people that were going to buy already bought, and now most people will start investing in real estate. So these new programs are popping out. For example, the DSCR loan is essentially a loan that uses the market rents a property will receive in order to qualify. So as long as the payment is covered and you have an acceptable FICO score, your income is not taken in consideration. Okay, so it's essentially a no income loan. Then we have bank statement loan programs. We have bank statement loan programs starting at 3 months of bank statements to qualify for a mortgage. Okay, many self-employed individuals are using this since we don't require tax returns for these loans. Another thing that is that we just reintroduced to the market in September is construction loans. If you guys recall, construction loans were very hard to come by. Very few banks had them because it takes some management post-funding to release the funds to the contractors that are building the properties. So now we have construction loans under FHA loans, under conventional loans, USDA loans, and VA loans. So technically, for example, with a conventional loan, if you're building your primary residence, you can actually buy it with 5% down, which means that if you end up building a property that costs $600,000 or $700,000, all that you require out of pocket is 5%, or it starts at 5%. Okay, that's a big one that we'll start seeing more and more as prices get a little higher. People that can afford those prices will opt to use a construction loan. The problem with construction loans, the limiting factor, is the lack of availability of suitable lots to build on them. Now, I'm not saying they don't exist. I'm just saying they're not as easy to come by as they were once. There's a lot of memes going around about the price of land. One thing that came into the market during last year, and it's becoming more important, it's a 1-year tax returns for conventional financing. So technically, once we run your loan through our automated system, if you've been in the business, in most cases, for 5 years or more in your business, in your line of work, we only require 1 year of taxes on most conventional loans, whether it's investment or primary. First-time homebuyer programs are not going anywhere, so nobody should freak out about that. And this one is a big one. The new conforming loan limits have gone up. If you guys recall, in San Diego County and in the whole country, not just in San Diego, but in this case, for the purpose of the call, let's talk about San Diego. 548,250 was the conforming loan limit last year in the country. And in San Diego, because we are a high cost area, we could go to about 750, okay, with something called high balance conforming. So essentially, you can still buy, with 5%, 10% down. It's not a jumbo loan. Now, those 548 to 50 got increased to 647 200, and the single family residence for high balance is now 879, essentially 880. So technically now you can buy with 5% down a $900,000, $915,000 home, which is crazy. If it's almost $1 million, guys, with 5% down. Okay. And I wanted to include this so that it was a little shocking. If you buy a 4-unit property, your loan will still be considered conforming as long as you don't go over $1.691 million in the loan. Okay. So now it varies if you're using FHA, if you're using conventional, et cetera, for down payments, but that's still a very, very high number.
Yeah, that's good. And just so you guys understand is in San Diego in the US, we have the most favorable loan products in the world compared to going to Canada or Mexico
By
and other
far.
countries where you need 20% down. So right now what Roberto just told us is you could buy a house in San Diego with only 5% down up to 900,000, or you could buy a lower price property with, a VA 0 down, or actually higher than that, but with other loan products. So it's very favorable. You guys should go out and get a loan. Do you have anything else for us, Robert, before we wrap this up?
Yeah, just one thing regarding what you just mentioned. The reason why this is very important is because the rates, conforming loan limits, if you go to a high balance conforming or you stay below the conforming loan limit max, which now is 647 200, rates are cheaper if you don't cross that threshold. So what's happening now is that now you have availability to cheaper money, okay, for a bigger loan, which means that this is my closing statements and I'll go through them very quickly. What we expect that will happen in 2022 is just a guess, okay? But prices are likely to keep going up due to the lack of inventory. That's, pretty much a given. Prices are likely to go up due to higher conforming loan limits. What I just mentioned right now, you could buy 5% down and get a really low rate at 548 before in 2021. Now you can go up 100 grand. So guess what's going to happen? That's going to push the prices in that range higher, because now some people couldn't buy over 600 grand or something like that because they couldn't get a loan with a lower down payment. Now they can. So now it's going to happen all day long. Rates are likely to go to 4% by end of the year, if not before. But they will likely go up and down. Okay. Rents are also likely to continue to increase. Why? Because there's no availability of rents. I mean, rental property right now are a hot commodity in the market and almost in the whole country, but especially in San Diego. So my only recommendation is do not stay on the sidelines. Get in the game. It's very rare. If I don't know, I mean, probably one of the very smart gentlemen that will follow me will know this data, but I don't recall personally a time that I've been in the business that the rates have been lower than inflation rates. So I'll leave you with that. Thank you so much for having me, Voltaire and team and everyone. If you have any questions, I will stay around. Thank you so much.
Appreciate it. All right. I'll open it up for a quick Q&A for anybody who has any questions for Robert or in regards to loan.
I see some questions real quick.
Sure.
Let's see. Okay. Okay, so there's a lot of funny comments but there's no specific questions. So
All right, I like that.
I will yield.
All right, cool. Sounds good. I know Alfonso was out there. He had a question. I don't know, Alfonso, if you still have the question or not. If so, you can unmute yourself, ask the question.
Yeah, can you hear me?
We can hear you, yes.
Yeah, on a construction loan, like let's say for instance, I know I have equity on the house. They offered me last year about 100 40,000 to come out. I didn't want to get it out because for whatever reason I just didn't feel it was right. But if I ask for a construction loan, would I be able to use that construction loan, or just go ahead and get the money from the equity, or would that affect my equity in any way?
It depends. So what is your ultimate goal?
Well, I want to do a 2-story building in the back of the house so I can rent it.
Okay, so chances are that if you had $100 and something thousand of tappable equity last year, you will probably have a little more. So in that case, it's not a ground up build up. So I would recommend for you to actually tap into your equity and use that to build up.
Okay.
We'll be happy
Got
to
it.
help.
Yeah, hey, that's a great question, and I think you should be doing that if you guys have the opportunity. And Abe Lopez is going to be up here in about half an hour, and that's what he does for a living. I think everybody should be considering that. If you're looking to make money, you borrow right now. Okay, that's number one. Number two, you use all the ADU laws and the new regulations that are coming out that are helping property owners to build in California and in San Diego. So stay tuned for Abe. Thanks for that question. And now, thanks a lot, Roberto. You did a great job and
Thank you for having me, guys.
educating
let me
us.
get a V. Can you hear
Yes. Yeah, we can hear
me?
you.
So a quick question from what he said at the end. So I guess a construction loan would have to be from ground up, because he mentioned that he
Yes.
couldn't.
Yes,
Okay.
yeah, it's for ground up. So technically, either you have the lot already, or you can buy the lot at the same time that we do the loan. The only limiting factor is that you have to have the permits and everything ready.
Okay.
Okay.
Gotcha. Okay. And Abe's going to talk about permits, how long it takes to build a house and how much money it takes to build. And we have a question from Ozzy. With inflation 30-year, 40-year high right now, should we wait for it to lower to increase the value of money, or buy now and wait and see? You buy now.
You will lose the advantage.
Yeah,
if you do
yeah,
that.
yeah. Don't wait. You lose. Yeah.
One
And then,
question in regards to the construction loans from ground up.
yes.
How much higher, or what time is the interest rate consider that you're going to be getting? So an example right now, it might be 3.3, but by the time the construction is over, it might be 4. So
You do what is called a takeout loan. Essentially, when you finish the property, it's ready to be habitable. If it's habitable now, then you refinance, normally based on market rates. And if you time it right, you might be able to get some advantages there, so that you don't have to wait until the last second to lock. But yeah, you will be subject to actual market rates when you turn it into a permanent loan.
Cool. Awesome. Thanks for that.
Real quick, the quick question is with inflation being so high at a 30 to 40 year extreme, you're saying ignore the extreme of inflation right now. It'll come down eventually, but go ahead and buy.
Yeah.
I'm buying. I'm buying as much as I can. I'll go over
So-
all the
so am
details
I.
why. Yeah.
I just closed on escrow a couple of weeks ago, then some before that Voltaire helped me with. That's our least, we're in the field and that's what we're doing, right? That's what we recommend.
Yeah, and I'll go over at the end why, Ozzy, but
Okay.
that's a really good question, and I'm going to answer that at the end in more in detail.
Thank
We
you.
have my pleasure. We have some other questions, which will go to the end because right now we're way behind on schedule. Next, Ajay Gupta, attorney. Ajay, what's up?
Hey, Volt, how you doing?
I'm good. Thanks for
for
joining
having me.
us.
Yeah,
Good to see you.
good
So
seeing you too.
we all know, right now, give us a quick bio as far as your experience in real estate and in bankruptcy, and and how long you've been doing
Sure.
it. Yeah.
Yeah, I've been in real estate. I'm, for about 25 years now. I'm probably starting to show my age a little bit more than I want to admit. But I went to law school. I was in real estate before law school. Went to law school, graduated in 2002. I'm sorry, 2005. I worked for First American Title. They're, if you're in real estate, you know who they are. They're one of 2 large insurance title companies that underwrite virtually all of the mortgages in the country. So either you're underwritten by First American or somebody that sells it to them, or Fidelity. Those are the two big behemoths. So I worked there for 2 years, opened my practice in 2008. Attorneys, my practice focuses on real estate litigation. I have a particular niche in bankruptcy. We've got guys that do evictions and all sorts of things. Anything dirt related, dirt lawyer related, we're going to be able to help you out with it, or at least point you in the right direction, because sometimes there's probate issues, or you need refi guys, or you need things like that. You need realtors and things like that. So, but usually if it's a litigation matter or a foreclosure matter, then I'm going to be the right person, the right resource.
So AJ's one of the smartest guys that I know. He's obviously has his hands in a lot of real estate type stuff and consumer type stuff with bankruptcy. I don't know. We could just do some questions, AJ, or if you have a presentation.
I do have a presentation, and I'll go through it quick.
Yeah, let's check it out.
And I'll leave a ton of room for questions, because it's really only 5 slides.
Perfect. Let's do it.
So, and let me see here. How do I want to? Do I need permission to share my screen?
You already have it.
Okay, great. So I'll do that. Go. All right, there we go. Let me move this over. All right, can everyone see this okay?
Yes, we can see it.
All right, cool. Then how do I make this big? All right, so first thing that you got to know about bankruptcies, all right, we're just going to go with it as is. The bankruptcies are what I call a lagging indicator of the economy. The number of bankruptcy filings, or even the nature of bankruptcy filings, isn't going to tell you much about where the economy is going. And typically people beg, borrow, and steal. They miss their payments, they get sued, and then they file for bankruptcy. And there's about a 2-year lag between, the peak of a foreclosure crisis and the peak of a downturn and what actually happens in terms of the number of filings. And so this is kind of a history of the number of filings in San Diego County here. And I updated this earlier today, and you can see, obviously not updated for December, but you can see, like, for us, 2008-7, 2008-2009 timeframe. This is when the foreclosure crisis started over here. You can see 2005 was a unique year, and that's when the bankruptcy laws changed, for those of you that remember that. So that there was a relatively large spike in there, and then you see it kind of crawls back down to this number of 4,200, and it starts going up once the foreclosure crisis started last time. So you can see here, the foreclosures started in 2007, and they continued to work I'm really messing this up, aren't I? They continue to work themselves up, but it wasn't until 2010, almost 2 years later, that you saw that the total bankruptcies peaked. And the difference between these two charts here, the number of total filings versus actual Chapter 7 filings. And what you can see here is you kind of work through these numbers, you get up to the top here, we were at 4,500, pretty much an all-time low in terms of the numbers of filings that we saw last year in 2021. And it wasn't because the court systems were slowed down at all by COVID. There were literally, like, the bankruptcy court did not shut down. It went forward as if nothing happened. So this number here for 2021 is not a product of the inability to file. It's just people they didn't have to file because, in large part, there was a moratorium on a lot of different things, whether it was foreclosures or collection suits, but also what you guys also know about is the amount of money that was being pumped into the economy. And I created this slide because I think it's really interesting to think about how much money has gone into this economy over the last 2 years as a result of COVID. And we just had the 2.1 trillion, I think it was 1.9 trillion actually that got passed in terms of the most recent stimulus package. And we had 6 trillion prior to that, whether that was PPP or aid to states or aid to whomever. $6 trillion. And what you don't realize is how much money that is. I mean, and so I put some context down here below for you guys. All the student loan debt in the country, $1.7 trillion, right? I mean, everyone talks about student loan forgiveness. They blew that away with this. All the mortgage debt in the country, all of it, $10 trillion, right? the current value of all the stocks in the New York Stock Exchange, $30 trillion. They just pumped $8 trillion into the economy in 2.5 years. And that was just stimulus. Forget about the wars and all the other crap that they pay for on an ongoing basis. This is the amount of money that they've put into the economy, which has made its way to people in some way, shape, or form or another. So when we look at filings and we say, wow, filings are down, you know, there's a lot of things that go into that, right? And I would say first and foremost, especially when you compare it to 2010, and Voltaire and Roberto spoke to this a little bit, but they've kept interest rates down, right? And what that's done is it's created a lot of opportunity for people to continue buying into this market, even under harsh economic circumstances. If there were harsh economic circumstances, people continue to buy. It has increased the supply of money, which has allowed property values to remain strong. And that's the big distinction between now and 07, 08, 09, is that property values are still remain right side up. So you're not seeing this pressure to foreclose on homes, and people who can't make their mortgage payment for any reason, they can turn around and sell their property because there is such a demand for it. And so there's not this outside pressure to sell homes. There's not this up and to drive the bankruptcy filings and to drive some of the negative aspects of foreclosure that come out of the marketplace. But it is a composite of the money being pumped into the economy coupled with low interest rates. That is why you're not seeing an increase in bankruptcies. So
Wow,
that's the bankruptcy component of the program. So
yeah, the thing that stands out is all the stocks in the New York Stock Exchange, 30 trillion, and they just pumped in about $8 trillion or less. That's a lot of money. That's crazy.
Astronomical sum, you know, like, and that's why I wrote it out. It's like, this is the number. Like, you don't even think about it. It's so much money. Like at some point you just lose concept of what we're talking about. And you need these frames of reference to understand those things. So, so evictions is another popular topic. I've spoken on this a few times. I'm not the eviction specialist. If you need more information on this, I'm gonna direct you elsewhere. But October of 2021, they lifted the moratorium on evictions. There are still some additional protections for evictions that are based on non-payment of rent. So for that, there's an additional 15-day notice, and then you have to take certain steps in order to evict for non-payment of rent. But it just takes longer, but it's very much doable at this point in time. So that's very different than where we were. What was it? It was August of 2020. Was when the CDC actually had passed a countrywide ban on evictions. It was one of the most unique things that had happened that we've seen, because it's very unusual for the federal government to get involved with what is traditionally a state issue. So, in addition to that, for those of you that don't know, you of course have the right to know ordinances, in San Diego, and now you have it also at the California state level. That's new as of 2020, is that you have to kind of ferret through. And what right to know says is that you can't just take a property off the market. You have to tell the renter why you're taking it off the market. And not only that, but you have to fit into certain buckets, you know, and so it can't just be, hey, I want you out because I don't like you anymore. It has to be that the property is coming off the market. It has to be that the property is being rehabilitated, the property is being sold, but you have to inform the tenant as to why you're taking it off, and it has to be a valid reason for taking it off the market. So it's not that right to know in San Diego has been in existence since 2004. So it's not new for us, but it is new for California. There are rent increases and limitations on rent increases as well. That's again a state by state. I'm not an expert on what those are, but if you need information on that, someone from our office can help you with that. So, so that's the state of evictions. And I know there's a lot of urban legend as to what that is. Now you know, you can go back and tell your friends and family that they can start evicting their tenants. Roberto touched on this, and this is probably the most interesting thing that happened, was SB 8, 9, and 10. And so these were bills that were passed towards the end of last year, again at the state level. And for those of you that are in this space, you know that probably, I think it was 2019, they passed the ADU legislation. So the ADU legislation said, hey, look, you can basically convert your garage into a standalone, what they call an accessory dwelling unit, right? So the ADU legislation made it so that you could effectively add an extra rental unit to your property without having to go through all of the nonsense. And by the nonsense, and I don't mean to call it nonsense because I'm for urban planning and I don't necessarily agree with everything that's in SB 9 especially, but without having to go through all the approval process. And so the biggest challenge that people usually had, and so if you're an urban planner, you're saying, all right, look, I only want to have, 2,000 people, 2,000 students in this school district. And so I'm going to map out this area so that it supports a density of X, so that we know that we have 2,000 students, that we can have 30 students per classroom, and then I'm going to build 10 classrooms. I don't know what the math works out to, but that operates at every level. It's not just for the classroom. It operates at how wide the roads are, how much parking there is, how many restaurants to build, how many grocery stores to service that area. And that's kind of the mindset that urban planners have is okay, we're going to control densities, and through controlling densities, we're going to be able to build and develop sustainable neighborhoods, right? And California is really good at this. I mean, if you go out to San Marcos, I mean, they build these giant footprints and before long, but the problem with that is it takes forever to build new housing because you have to fit into their boxes. And what the ADU legislation did was it said, all right, look, we're going to increase density because we're going to let you take your garage and convert it into a granny flat. We're going to let you rent that granny flat out. Even if you don't have a parking space for them, we're going to let you figure it out. Okay. And that's what SB 9 does for lot splits. So when we talk about doing a backyard addition to the house, that's what SB 9 addresses. You don't need to have parking. Parking's the big one, right? Normally you have to have a parking place to put your cars before you can do a lot split, before you could have added a granny flat. That was always the impediment to doing that. They've done away with that. So these are some basics on what SB 9 looks like, all right? So if you have a lot, you can do one lot split. Each lot has to be at 1,200 square feet, right? And like, again, just putting the math to the numbers, that's small. That's not a lot of space to do a lot split, right? And that means these lots can now be sold independently. You can put a new house on it and sell that lot independently. And so 30 by 40 is the minimum lot size, right? Like that is not a big amount of space. And so these are the basics on SB 9 here is no short-term rentals. There's like, and again, this has to do with the purpose behind SB 9. They're trying to create single-family housing to alleviate the stress on housing prices, to create availability and drop the demand for rental or the pricing on rentals, right? So no short-term rentals. And again, they can't extract certain things. Normally, when you're doing a development project, they're going to tell you, hey, look, you got to build a road. You've got to, build this particular thing. You need to put a light pole at the end of the street. So normally, if you're trying to do a lot split, they're going to be able to extract improvements from you off-site in order to allow you to do that. So they can't do that anymore. The parking limitation is it's not gone. It's virtually gone. So there's things. The biggest limitation that they have here is this is specific to owner-occupied residences. You have to have occupied the residence as your primary residence for 3 years. All right. So as an investor, your access to SB 9 is somewhat limited, but as a realtor, you should be able to spot potential properties that are out there that you could say, hey, look, I might be able to help this person monetize this property in a way that they hadn't seen before by doing a lot split, by selling the second lot, by helping them build on the second lot, by financing the second lot, by creating value through that second lot, and so that it can be sold for them. So that's really where you can add value from an investment perspective, is by identifying these properties for people, helping them monetize it, helping them figure out how to make the most of this.
Cool.
Um,
And we're running short on time.
cool.
And maybe we
I'm
could
done.
just,
That was my last.
that was
This
it.
is my last
Cool.
slide, and it's a bunch of crap. So.
All right. Yeah. You know, I like that because anyone who's on the call, and there's a lot of people on the call, clients, past clients, with real estate, that own real estate. So if you guys own a property, think about this law. And then at that point, you know, we could connect you with Abe Lopez, who could walk you through it. And then that's pretty cool.
Quick question, V. He seemed to allude to the fact that the owner could, if the owner had already owned the property for 3 years, but it seems like here it's saying that you need to occupy the property for 3 years after the split.
I think you have to live in it for 3 years after. Is that accurate, AJ?
I thought it was that you had to own it for 3 years.
I think Abe Lopez might know. I don't know if Abe's on the call. You could answer that real quick, Abe.
That was my understanding of it. I know that this says differently, but my understanding was that you had to own it.
Yeah.
Well,
Can you
Go
hear
ahead,
me
Abe.
now?
Yeah, we could hear you.
So
Hear you.
AJ, he's correct. The intent for the SB 9 is for owner of the house. So you have to be owner occupied on the property, and you have to sign a contract that you're going to be on that property, you're going to live in that property. You cannot move to other properties. You cannot sell the other properties. And if you split the lot, you can sell the property next to you, but you have to live in the one you keep at least 3 years. So this is only in that case. So if you want to sell it, you won't be able to. They lock you on that property.
Cool.
The intent
so
is
the question, I think the question Jerry's asked is, do you already need to own it for 3 years, or can you just buy it today and then use AB 9 as long as
I don't know the answer to that. I can look that up for you though.
Abe, do you know it?
Can you repeat the question?
Okay. So can you buy a property today?
Yeah.
Do the split and live there for 3 years, or do you need to live there already for 3 years and then apply for this?
No, you can buy the property with the intent of living in the house.
Okay.
And
cool.
then you have to finance the house as you own or occupy. You cannot buy it as an investor. So that's the deal.
Cool. Cool.
Yeah.
Perfect. Thank
So
you.
just to wrap up a few things that we are talking about is California is trying to push as many units as possible. So they're doing it in 4 ways. One is the SBA 9. The second is the ADUs, affordable house, and then the third one is affordable housing, and then the fourth one is opportunities, complete communities here in San Diego. So
Cool.
they're trying to push as many units as possible so they can drop the price for housing, so people can stay in San Diego, because there's a lot of people leaving, especially today that you can work remotely.
Yeah, and I think we're going to talk more into that because I got some questions for you there. And so you're up after Dr. David Fogel.
Okay.
Any questions for AJ and all the information that he provided? Does anybody have any questions before we go on to Dr. David Fogel?
No, great info.
Thanks, guys.
Cool. Yeah. Thanks a lot, AJ. All right. So appreciate you. Now, Dr. David Fogel, welcome.
Hi there. How you doing? Good to see you.
Hey, good to see you. Good to see you. So I'm always excited to see what you got going on, because tell us a little bit about your background and what you're going to be going over today.
Yeah, certainly. So as it turns out, I just will say this way. So year number 38 for me in artificial intelligence, which is a long time. So my dad was one of the pioneers in AI in the 1960s, Larry Fogel, kind of a famous guy, was the inventor of active noise canceling headphones before Bose did anything with them in the 70s. And also had the idea of simulating evolution on computers for machine learning when computers were as big as the room that I'm sitting in right now and didn't have a hard drive. So he was quite ahead of his time. I tried to catch up with him, and I followed in his footsteps as best I could. So my background's a bachelor's degree in statistics, math from UC Santa Barbara, PhD in engineering I've worked in all sorts of fields, including finance, and for the last, 8 to 9 years with Sandeep Varma at ATS Financial, ATS Wealth Management as research director for them. Also contribute on some of the books that they write, publish, I should say. And happy to go into any other background anybody might like to go in on me, but I think it'd be better to just jump to the S&P 500 and see where we are here.
That's pretty cool. And by the way, before we jump into the S&P 500, why is it so important for us to know, I mean, what the S&P 500 did last year and what's going to, you know, what the trend is? I mean, what is it? Why is it so important?
Well, you know, as they say, when America sneezes, the rest of the world catches a cold, right? And it's kind of the same thing probably for real estate as a sector of the S&P. If the S&P is going in one direction as a general movement, as a general wave, it would be highly unlikely to think that real estate is going to be the one sector out of 13 to 15 that's going some other way. That's possible, but I think you would probably want to know what direction the tide is going in order to know which direction your boat is going.
Cool. So the S&P is just like it simulates like the U.S. economy, basically, right?
Yeah, basically the 500 largest market cap companies that are public in the United States market. It's theoretically possible to have some foreign companies that have ADRs that you can trade here that might be in that category. I really don't know if there is one or two or many. Haven't researched that, but it's theoretically possible that would be the case. And I should say that Investopedia and Y-Charts are now having the total market cap at 40 trillion, just over 40 trillion. But not to take anything away from AJ's presentation, $8 trillion plus of stimulus going on 30 or 40 is a lot of stimulus. Okay, so it's no surprise that the S&P 500 had a great year, up 26 and 28%, depending on how you measure it last year. We can take a look at that chart if you like.
Yeah, let's do it.
All right, so I'm sharing my chart here. So this is the Thinkorswim platform, and this is a one-year chart of the S&P 500. And we'll go through it relatively quickly. I'm sure you guys have seen these sorts of charts before, but just to catch everybody up, the green bars here are days when the market went up. The red bars are days when the market went down. This is 1 year ago to today. So today we were up about 0.92% on the close. And that's good. We'll come back at the top. So what I do with Sandeep and others is look at this on a technical basis. A technical basis means we look for statistical patterns in the market, and when they're established, we note them. And then when they change, we also note the change and look for what the next statistical pattern is going to be. And part of the things that we do for looking at those sorts of relationships involve moving averages and support and resistance and things like that. So I'll just take you through that relatively quickly. This yellow line here is the 50-day moving average. You can see it's trending higher, although very recently it's trending flat. So that means some momentum has come out of the market move recently. The 200-day moving average is in purple. As long as the yellow line is ahead of the purple line, that's a positive sign. When it crosses to the upside, that's called a golden cross. If it crosses to the downside, that's called a death cross for obvious reasons. And it would be signifying that a recent prices have been falling. So in this particular case, we have good margin between the 50 and 200. That's a positive sign. In addition, we have a resistance and support in channels. So you can see this white line here is resistance. When the market has gotten to that level, as it's been trending higher, it has tended to not break through that level. Occasionally, a little peak above it, but generally that has been the bounding resistance. So what that's saying is like the price of the Snickers bar is just too high at that rate, and people will want to sell it and capture the profits and wait for it to come back down. Same thing on the bottom side, we've got trending support, which we did break here in September. September was a down month, including some concerns about Chinese developers defaulting, as I recall. You guys would probably remember that story more accurately than I would. But in any event, the market rebounded from that, reestablished itself in a new channel, which is here with support and here with resistance. I have a couple other little lines that are in there, but I think it's important that we know where the Bollinger Bands are. The Bollinger Bands are the light blue lines here. They contain about 95% of the market movement on a day-to-day basis. Basically, it's like putting a bell curve over the moving average of the last 20 days. And the market does not necessarily move in a nice bell curve Gaussian distribution. It typically has fatter tails than that. But this is a handy way of saying whether the market is neutral or overbought or oversold. Right now, you can see that we're in between those Bollinger Bands. We tested the top of them, came back to the bottom of them, did not break them. We did break them a little bit down here. Typically, when they get oversold or overbought, haven't seen too many instances of overbought lately, but if they get overbought, the typical thing is to see a retrace inside the Bollinger Band and not stay overbought or oversold for very long. So this was a quick oversold and back inside, a quick oversold and back inside. And generally what happens is the Bollinger Band holds up as support or as resistance. A couple other support levels here, as you can see, and the arrow would be where a 10% correction would be from the 52-week high. So we have quite a ways to go before we would get to a correction. We'd also have to get back through the 50, through support, through the Bollinger Band, through this support, through the 200. There's a lot of support levels there below. We did have a pullback here when the Fed minutes were read. They were a bit hawkish compared to what the Fed announcement was at the prior FOMC meeting. So the market sold off there where we had interest rate sensitive things in the NASDAQ and also things with small profit margins taking the biggest hit. We went back down all the way to support and then bounced up today. A couple other technical factors that I look at are the moving average convergence divergence, which is basically just how two different moving averages are moving relative to each other. And to make it simple, when the golden one is crossing below the white one, that's a down signal. So like here would have been a down signal, and indeed we would have had a sell-off. Here's a up signal, and it's a little late to this one, but we would have had a little bit of a gain. So this one right now is down, but the stochastics, which are based on a percentile movement in the last 10 days, are up. So we have a little bit of a mixed bag, and I would say from the last 2 months, mostly sideways. If we zoom in here for a little bit, I can do it this way. Oh, let me see. Maybe I've taken the drawings off. Hang on one second. Sorry about that. I did that earlier. Here we go. Put my drawing up. Now it should let me do this. There we go. Okay, so this is the more recent day-to-day movement of the market. You can see we had 5 days in a row down. It's the big day that was the FOMC minutes day. We have inflation numbers coming tomorrow. As we've been noting here on this call, they're very high, relatively speaking. We'll see just how high the government reports them to be tomorrow. But for right now, we're back on the 20-day moving average. So that's neutral. And we have a neutral stance going in. I think it's important to step back for a minute, especially listening to what you guys have been talking about for historical purposes, and say, where did we come from? So like, for example, here's a 3-year chart. And the orange line here was the major trend line from when President Trump was in office. Market did very well, of course, when President Trump was in office up until the COVID-19 pandemic and the government shutdown. It's good to remember it's not the pandemic that caused the market to crash. It's the government reaction to the pandemic that caused it to crash. And we did, of course, get below the Bollinger Bands on a weekly basis down here, very oversold. But then stimulus starts, and we're on a very strong trajectory here as we go forward. So, you know, that's what the recovery has looked like, much, much faster than what we were doing before. Let me go and show you a 5-year chart. Here's the 5-year chart. Hang on a second. There we go. So again, you know, very strong time for when we had the prior administration, even stronger now in the current administration, but really that's more just an extension of the COVID recovery rather than any particular political point of view or political comment on my part. So at this point, we're looking at like whether or not the momentum of this move can continue and for how long it can continue. And the major thing, in my view, that will have it continue in the short term is whether or not earnings are reported as expected in this first quarter. So we have trillions of dollars over multiple years. They don't all go in at once, but we have trillions of dollars over multiple years coming into the market. The P to E on the price to earnings ratio on the S&P 500 right now is a little bit above 29. Just for some context, for the time immemorial, the average is 18. And the time since the internet, it's 22. So as far as I'm concerned, the internet changes everything, and that 18 number is not particularly relevant to me, but 22 is relevant. So we're quite a bit over that 22, and the way to adjust to P to E, of course, is to either adjust the numerator or the denominator. And right now, we're going to get an adjustment on the denominator with earnings. So hopefully, earnings will be in line or ahead of where we project them to be, which will bring the P to E's down a little bit and have them be a bit more reasonable. Because I think when we start looking at a price earnings chart, which I think I could even pull up for you on the fly, if anyone's interested in seeing it, it is remarkably high currently. So, but overall, on a technical basis, I think, you know, things look very positive technically. And if we go back to the 1-year chart and say, what are we doing in the short term? Really, it depends on the Fed to see whether or not they're going to continue with their with their interest rate and bond buyback drawdown. We'll know a little bit more about that at the end of January when they have their next meeting.
Right. Cool. Thanks for all that info. And, I mean, it's a lot of info. It's not something that we're accustomed to. Now, the market and the reason why S&P is important and stocks is important to all of us is because a lot of us have 401ks. A lot of us have money in the market through our company or on our own, where we actually need that money for down payments, right? On real estate, or just to have in there in our personal wealth. So with your experience all these years, like it's just gone up like crazy, right? And so has real estate. And people ask me all the time, hey, I'm waiting for it to drop before I buy real estate. And I tell them, hey, no, I think it's going to keep going up. And I have a lot of those reasons, which I'm going to go over in a bit as to why I think that. Now, I don't know stocks and the S&P. So with your experience, do you foresee like us being able, or the market being able to sustain and keep going up? Or is it, what do you see?
Yep. So it's always possible for the market to do anything. That's the first thing to say. The next thing is, since the $8 trillion may or may not be the end of it, we don't know that. And my belief is it's not the end of it, but we'll see what politics prevails as we get into the election coming up here. It takes a while for that money to filter through, and we will see whether it filters through in an efficient way or an inefficient way. So you may remember back in the Obama administration, we had several stimulus rounds. And one of the things that was noted at the end of those stimulus rounds is not a lot of that money actually got to where it was supposed to be. And you may remember a famous quote from the president saying, some of those shovel-ready jobs weren't so shovel-ready. We don't know, right? We don't know for that. If things are better executed than that, I would say there's plenty of wind behind this to keep it going. There's also any number of things that can happen that would derail the market considerably. So the Fed, for example, is the number one thing that one can think about. It could say, hey, we're going to aggressively raise interest rates because inflation is not going to be temporary in their view. And all of a sudden, the Fed's going to kill the market and kill inflation like they did at the end of the 70s into the 80s. That would be one. Another one would be political conflicts around the world, which we have no control over. China decides to do something with Taiwan, the market will not react well to that. Russia decides to invade Ukraine. I can't tell you, really definitively how the market reacted to that in the medium term. Short term, probably a negative. But in the medium term, I mean, how much business is Ukraine? That's what it is, so we have to look at these things matter-of-factly. What the next variant of COVID-19 is going to be. We got a little lucky with Omicron that it's not as virulent as Delta, right? So any number of things can come along and make it in a short term down, but with $8 trillion of stimulus coming in over the next decade, let's say, barring other political decisions to stop it or to increase it, but let's just say to stop it, I would say at this point, the wind is behind the market pushing it.
Cool. So basically you would put money in the S&P and bet on the economy.
Yeah. So as a person who works in wealth management, I'm not allowed to say that, but I would say, anybody who has an appetite for risk should be probably attracted to equities.
Cool. Awesome. Thank you very much. I appreciate your time. Any questions for Dr. David Fogel before we start talking to Abe Lopez about construction? That was a lot. I enjoyed that a lot.
Thanks very much,
you.
everybody. I appreciate it.
Yeah. Thank you. All right, cool. So Abe Lopez, architect, builder, designer, welcome. Thanks for joining us. And I know when I reached out to you, I was like, hey, let's talk about just this, we're negative. I believe we're about negative 30,000 housing units in San Diego County. Right.
I think it's more.
It's more. Okay. So we're negative tens of thousands of housing units.
Yes.
That means that there isn't enough housing for people that want it. And that causes rents to go up, right? That causes home prices to go up. There's only 1,400 homes 1,400 homes for sale in San Diego. That's an all-time low. Okay.
Yes.
Normal market is about 7,000 homes. So if we need to build homes and they pass these ADU laws and they passed AB 9 so you can split your lot into two, and the government basically knows there's an issue and they're trying to build. But the issue, the reason why I reached out to you is because it takes forever to build, and the fees just to build are super expensive, and there's probably all these things that I'm missing. So what insight do you have for us? Do you want to share your screen, or do you just want to talk to us about what's going on?
Okay, I'm gonna share my screen.
Cool. Let me see. I got you here. Cool. You can share it now.
Okay, I'm gonna share my screen, and I'm gonna share it completely because. Okay, so first of all, no inventory, right? So what's the problem? We already talked about this, is the high demand, low inventory. Now, inventory is not only in housing, it's also in materials for construction. So there's not enough windows, doors, anything. Everything is done in China and it's taking forever to come over. And the price for steel and for gas, everything went up. So the construction cost it went up too. So the other one is rent has been higher and higher and higher, but the mortgage loans are also increasing a little bit by little. There will be a point when rents and mortgage are going to be closer. So that's when things can get better for us for buy a property in a better price. So what's the city is doing and the state is doing is trying to provide affordable housing. So that means they are going to cap the rents in some sections in some areas. So you were saying again the same thing. Prices are going up. Single families, condos, and everything, and also inventory is just dropping low. It's like there's nothing on the market. I've seen properties that in the same 3 or 4 months they just increase $150,000 to $200,000 in just a matter of 3 months or 6 months. It's just incredible. So first problem. Designers and consultants, structural engineers, Title 24, and civil engineers, everybody's overwhelmed with work. So there's so much work that it's really hard to find somebody that has the time to just jump on your project. So that's the first thing that we have a problem with. Okay, so I just noticed that my slide is a little bit wrong. So on opportunities, what the city is doing is they're trying to change the way we build the cities. They want to create more trolley stations, more bus stops, more bike-friendly streets, more pedestrians areas. So what they're doing right now is they're saying, okay, on all the single residence areas, we're going to provide a little bit of help with the SB 9 law and with ADUs, accessory dwelling units and junior suites. So we're not increasing too much the density in single family residence, but we're basically doubling that zone, okay? So SB 9, not only you can split the lot, but you can also do duplexes. Now, duplexes and junior suites or ADUs are not appraised the same way. And a duplex is appraised better than an ADU. That's something that you have to see. Another thing they're doing is creating opportunity zones. What it means is you can buy something with capital gains and you won't pay taxes if you buy it with the intent of develop it and keep it for 10 years, okay? The third one is affordable housing that we talk about, and they're giving you more density. They give you 50% more density to 100% more density. And even with that, they're also doing affordable ADUs. You can create for example, in San Diego, in a multifamily zone, on the TPA, you can do as many ADUs as possible if you make them affordable, 50% of them. And the rents for affordable ADUs are really, really high. And then last is the opportunity zones. It's not opportunity zones, complete communities.
Yeah.
Complete communities. So they're increasing the FAR, so you can go to make a really, really big building. Now, for permit costs for ballpark numbers, an ADU can be from $6,000 if you convert a tiny garage, to $16,000 to a bigger ADU. New construction can be for $18,000 to 30,000. Depends on the county. It depends on the
And
city.
these are just fees, permits for like the paperwork
Permits,
and the
just-
architect and
No,
stuff.
this is just the city.
Just the city fees. These are just
Just the
city
city.
fees. Okay.
Just the city. Okay, and multifamily, what we are using is a rule of thumb or $25,000 per unit average.
Got
It
it.
changes on the city, it changes everything. Okay, this is
So-
just this. Yeah.
So guys, if you guys are out there and you're thinking about converting your garage or something in the backyard, that's why ADUs are so attractive, because it's going to cost you $6,000 to $16,000 for city fees compared to, you know, building new construction, $18,000 to $30,000, or a multifamily building for $25,000 per unit.
Per unit. Yeah.
Yeah.
Not counting the scrutiny, right?
No. These prices can change dramatically. For example, if you create ADUs, but the city tells you need to change your water meter, that fee can be 20,000 now. So everything changes dramatically. This is a ballpark numbers. It's just what I've seen and what I permitted recently. Now, the construction cost. I've seen prices from $200 per square foot to $350. That's new construction. I've seen remodels for $180 to $200. Depends on the finishes and depends on the slope, and this depends on many factors. Normally, most of the prices I've seen is $300 per square foot. All the contractors that just do an ADU or a new house, this is basically what they charge. And multifamily can go. Sorry, I added another zero there. 300 to 450. Now, it can go higher. Why the multifamily can go higher is because if there's different types of construction. If you do type 5, that's framing, that's between 300 and 450. But if you go to type 3, that it's steel and concrete, the prices go up. So you have to have a lot more units and a higher building so you can dilute that construction cost per square foot. So design timeline. A lot of people are asking for the permit time, but not a lot of people are asking for how long it takes to design something. So the problem is everybody's super busy. So if you talk to any designer right now, they're like, okay, I can start your project in 4 weeks or in 6 weeks. And it normally takes like another 4 weeks to create that project. So it takes about 2 months. So anybody can just take your project and start designing it just for an ADU or residential thing. For multifamily, it's more complex. You need a structural engineer, you need a civil engineer sometimes, you need an acoustic engineer, and you need a lot more consultants to work on that project. And it's normally taking 6 months to more. And just the residential is the same thing as an ADU. It takes about 2 months.
And this is just to design.
Just to design it. Yeah, a lot of
Got it.
people think that you hire an architect and they're ready to go to submit it to the city. It's not true. We need time to do it.
Cool.
Okay. So just a structural engineer, you need to hire him like at least 4 to 6 weeks in advance because everybody's super busy.
Got it.
So, okay. So time for permits. Now, this is the biggest problem. A lot of people quit at the city, not only in San Diego, but in any other municipalities. For example, in Encinitas, they made a mandate to get vaccinated and a lot of people quit. So I just heard from a friend of mine that went to get a permit, and the lady that talked to him just started 4 days ago. So this
Could be
is
a
one
good
of the
thing.
biggest.
She might just approve it.
Exactly. Or maybe she feels like, I don't know what I'm going to do. I need to talk to my supervisor, and the supervisor is super busy.
Right.
So this happens all the time. Now, a lot of people quit or got retired because they start working online and they didn't like it. Before COVID, everything had to be done by paper. Like you have to print the sheets. And today, most of the cities, they're done online. So it's saving you a lot of money on prints. Just to give an example, a fourplex that I was permitting, we were spending about $2,000 on prints. And now we're saving that money because everything is a PDF. We just print the last print and it's like $75. So it's a lot of money that you save.
Wow.
Yeah. So the problem is the people that knew how to review those plans were older. So they're one of the first ones that quit. It's like, I don't want to work online. I want to see the paper in front of me. I want to be able to write on top of it. And so there's new blood at the building department and the county, everywhere, there are new architects and designers to reviewing the plans that they're not really savvy about it, and they're overwhelmed with how much work they have. So also during the pandemic, a lot of them were working part-time, not full-time. So they can go to the building department, but they stay just like 2 days of the week.
Wow.
Yeah. So normally an ADU should be done in 60 days, but it's taking about 4 months. Not only because the city takes it too long, but also like you're just waiting for them to send you an invoice. So to give you an example, San Diego, you submit a permit, and normally before COVID, in the same time you submit the permit, you get an invoice so they can start the review. Today, sometimes they take 4 weeks to send you the invoice so they can start the review. Okay. And then they start the review, and sometimes some of the reviewers, especially structural reviews, they have a due date. They say in 10 days I have to respond to comments, and sometimes they respond back and saying we are 1 month behind. So it depends on the complexity of the project, and also it depends on the type of project you have. If you're doing affordable housing, they go in a different lane, they go faster. And also you can pay on top to do it expedite. I don't see a huge difference to make them expedite. It's just taking too long. Now, if you do multifamily, an apartment building, it takes about 12 months. Also, when you get the review comments, you need to coordinate all the consultants to respond those comments. So it takes time too. And coastal normally takes like 2 years. It takes just 1 year to get a permit from coastal, just to get the city to review the project. So sometimes it's faster. I've seen guys that are experts in coastal, and sometimes they get the permit like in 8 months because they know somebody inside. We hire them directly, but normally it takes a long time. So a lot of investors, as soon as they see coastal, they're like, no, I don't want to buy that property. It's just going to take me too long. Especially if there's a big building, it's going to take longer. So
cool.
Construction time. An ADU can be really, really fast, especially if it's a remodel, if it's in a garage or something that is already there. It can be done in like 2-3 months. But a new building can be between 6 months to 8 months. And a multifamily can take a year to 18 months to 2 years. It depends on the complexity of the project. And coastal is basically 8 months because sometimes you need to advise to let the neighbors what you're going to do. Sometimes they don't let you work late. They don't let you work early. And those things can make you a little bit, linger on the project. Okay. So I just want to show you something else before I leave. So basically what the city is doing is complete communities. They're multiplying the FAR. For example, I know this zone pretty well. This is Golden Hill. This is where your office is. And if you can see, this is a green area. Normally, this FAR means that you can build only like 4 stories, okay? But if you do this, they can give you 6.5 FAR. Basically, what you do if your property is touching the green in any portion, you multiply the size of your property by 6.5, and that's the number of square feet that you can build. So it's 6.5 stories. So just to give you an example.
So what I would recommend everybody, zoom out a little bit, Abe. I would recommend everybody on this call is, there is the new thing called complete communities. And if your property falls within this, your property could be worth substantially more than what it otherwise would have been before this past year, before this new thing. So you could reach out to us and we could pull it up for you guys and let you know whether it is in that zone or not. But that's a huge opportunity in case you do own something like that, or you buy a single family home in that area. Later on you could build something mammoth and make lots of money. So that's really good information, Abe. I appreciate you. And thanks for highlighting what's going on with like why we don't have that much inventory and why there's this huge housing shortage, is because does take 6 months, a year just for the permits, 4 months for design, 8 to 12 months to build. I mean, this supply issue isn't gonna be fixed anytime soon, right? Especially people quitting at the city, and now
Yeah.
these young bloods out there that just don't know what they're doing, and it's just, man, sounds like a mess.
And also, like, one thing important and on complete communities, you can buy a property and it's on a great FAR like 6.5, and you go ahead and get all the permits, but by the time you want to build it, the construction cost can be totally different. And then you're like, I cannot build it, it's too expensive now, or it's too complicated, or something like that. A lot of the problems that we have on complete communities is the properties they buy, they're too small, even though you have a huge FAR. You have to create a pencil building, and pencil buildings are really expensive. So the architect sometimes do not advise the owner, just get the permits, but when they get a contractor, it's too expensive. So we have to be careful about that.
Yeah, no, that's yeah, you might not have the money whenever it's time to build, or you
Yeah.
might not be able to find the contractor because the contractors are spread super thin right now. It's super tough.
That's a good point too. Yeah.
Thanks for going over that. Right. So with Abe's information now, that's going to go nicely with our information here that we have. Thanks a lot, Abe. Thanks for sharing. So what I'm going to do is I'm just going to go over the market really quick, and I'm going to go over what I think is going to happen with the real estate market. So some key points: housing inventory, all-time lows. We're at 1,400 homes for sale in San Diego County. For those of you that says, hey, I'm waiting for the market to crash. Well, guess what? When it crashed in 2008, it crashed because we had 16,000 homes for sale. So if we're only at 1,400 and you're waiting for the market to crash, then hey, I don't know. You might want to binge on some Netflix shows and wait for that to happen. I don't see 16,000 homes coming on the market anytime soon. Buyer demand is super strong. 90% of all the homeowners in San Diego County have 20% equity, positive equity. So what happened in 2008, and the reason why a lot of people lost their homes is because they were underwater. They didn't have any equity. Most people did not have equity. Right now, over 90% of homeowners have 20% positive equity. So if they lose their job, they can't make their payment, they just sell it, make money, walk away. Worst case scenario. Days on market, they're selling super fast, 19 days on the market. By the way, anything less than 60 days on the market is considered a hot seller's market. A neutral market is about 120 days, 90 days to 120 days. That's a neutral market, not a buyer's, not a seller's. Anything under 60 days is considered a hot seller's market. So what is 19 days considered? Hot seller's market, scorching. Rental occupancy rates, 99%. There isn't any rentals out there. I feel bad for people when they reach out. Hey, Voltaire, do you have any rentals? Like, no, all my properties are rented out. All my clients' properties are rented out. Rents have been jumping. And a big reason why rents are jumping is because of the rent control laws that were passed in California a couple of years back. That forced every landlord in San Diego and in the state to raise their rents according to the state guidelines, which sucks for tenants that were living in their properties and had really low rents. At that point, the owners, they're forced to raise the rents on a yearly basis. So rents are jumping. Interest rates, they're still low, right? They're anywhere between 3 and 3.5% right now. Airbnb, there's a lot of people that are buying Airbnbs for investment purposes. We'll talk a little bit about that in a bit. It could be risky to base your complete financial analysis on the purchase on an Airbnb because Airbnb laws are going to be changing, it seems like, soon. So a look back at 2021, we started off last year at 2,400 homes for sale last January. Right now at 1,400 homes. So, and last year, 2,400 homes wasn't a lot. A normal market, 7,300 homes. That's the 5-year running average, 7,300 homes for sale in San Diego. And again, right now we're at 1,400 homes. All right, so there definitely is a supply problem. Again, we normally have 7,000 plus homes on the market. Right now we're at 1,400 homes. All right, so that's we already talked about that there. Demand, we think it's going to go up this year 8 to 10%. The housing cycle is going to be a normal cycle, which means it's going to start off, the spring, it's going to get really, really hot into the summer months, and then autumn and November and, October, November, December, it's going to slow down just like it does, every other year except for 2020, which was a crazy year. And then sales are probably going to decrease a bit. 2021 had the most sales since 2005. And if you guys remember, 2004, 5, 6 were super hot years as far as sales. 2021 surpassed 2005. This year we might drop a little bit just because we don't have enough properties to sell. The luxury real estate market is super strong. I mean, there's so many people that could afford luxury right now, and luxury is in San Diego County starts about 1.25 million. Distress. Okay, this is interesting. Distressed properties, people that can't afford to pay their properties, people in foreclosure, people doing short sales. There's only 15 distressed properties in San Diego. 15, 1-5. Can anyone guess, for extra points, how many distressed homes there was in 2009, right when the real estate market crashed?
3,000-4,000.
3,000 or 4,000. Good guess. So remember, there were 16,000 homes for sale back then, and 8,000-ish, about half, were in distress. 8,000. Right now, we're in 15 people in all of San Diego County in distress. So what does that tell you? It's a strong market. People could afford their payments. Why? Because after the market crashed in 2008, banks weren't just giving out heartbeat loans, right? Back before 2008, if you had a heartbeat, you would qualify for a loan. After 2008, they would verify income, bank statements, W-2s, tax returns, and all that. Now, this is pretty cool to see. Well, cool or crazy, whatever. The medium active list price home right now is $838. The average sold price home in San Diego last year was almost $1 million, $969,000. A lot of you guys are going to be like, "Oh my God, that's crazy. It's overpriced." Right? At $1 million, everybody thought that everyone thinks that it's overpriced. So what I want you guys to do is give me a few minutes so I can show you why it might not be overpriced. I want you guys to think outside the box. So this is, when I say think outside the box, this is the premise. The average sold price last year, 2021, was $969,000. That's a lot of money. That's a lot of US dollars. A lot of us, when we look at houses, we look at it and we go, $900,000, $800,000, $1 million. It's a lot of money. Well, it is if we're looking at US dollars. But what if you were to buy that same property with something else besides $1 million? Okay. Meaning, what if we use commodities? What if we said, okay, how much can I buy that house that's 900,000? How many gold bars do I need to pay the homeowner to sell me this property? Or how many barrels of oil, right? And then we say, okay, let's say it's 6,500 barrels of oil. Then we compare it to 20 years ago and we compare it to 50 years ago, how many barrels of oil you needed to buy that house instead of US dollars. Because when we talk about just US dollars, of course it's going to be expensive because that's a lot of money. But we all know what's going on with inflation. Therefore, it devalues the dollar. Okay, inflation devalues the dollar. So now let me share with you guys, think outside the box. There's this Hartman comparison index that compares home prices to other commodities. So in the year 2000, for example, okay, right here, the median price home in the US was 173,000 and gold price was 283 an ounce. So you needed 610 ounces of gold to buy the median price home. This last year in 2021, you only needed 212 ounces of gold, right? If you compare it to, to the year 2000, home prices in gold, well, guess what? Right now, it's way cheaper to buy a house in gold than it was 20 years ago, right? And then if you compare it to just 10 years ago, 11 years ago, in 2010, it's about the same price. 212 ounces of gold compared to 208 ounces of gold. So compared to gold, are prices for homes expensive right now? No, they're actually cheap or affordable, right? There's still room to run. Now let's compare it to oil, okay? So a barrel of oil, if you wanted to buy a house 21 years ago in 2000, you needed 6,300 barrels of oil to buy the median price home. This past year, you needed 5,500. So you needed less barrels of oil to buy a median price home in the US last year than 21 years ago, right? Again, we're thinking outside the box. We're not thinking in US dollars anymore. We're thinking in commodities. And if you want to go back 51 years, right? 1970, you needed 6,700 barrels of oil to buy the median price home of $22,000 because oil was only $3 a barrel back then.
Hey, V, this chart is nationwide, right?
Nationwide. Yeah, medium. And I've ran the numbers in San Diego, and it's still, San Diego has it's still affordable. But this just shows you guys that right now you need, if you owned gold or you owned oil or other commodities, you could buy houses right now cheaper, right? So what does that tell us? That tells us that the US dollar has been devalued because of all the inflation that's been going on throughout the years, right? It's not as strong as it once was. So now let's look at it as, rice. I don't know if they call it bags of rice or barrels of rice or whatever, but the weight of rice, let's say. So if you looked at this right now, you needed 27,000 pounds of rice or bags of rice, I don't know. Compared to 51 years ago, you needed almost double, 42,000 to buy the median price home. 21 years ago, you needed 31,000 to buy the median price home of 172,000. And last year, you just needed 27,000, right? So these are some reasons why I'm saying, like, man, you know what? It's a good time to buy. Now let's look at the S&P 500 stock shares. Okay, 20 years ago, if you wanted to buy a home and you wanted to pay with S&P 500 shares, you needed 119 shares 21 years ago. Last year, all you needed was 80 shares to buy that same home, the median priced home. Okay, we talked about home prices. Let's look at monthly payments. Okay, 21 years ago, for the S&P 500, you needed to trade in every month 0.7 shares of one S&P 500 stock in order to make your monthly payment. Last year, you needed to only trade in 0.3 shares to make your monthly payment on a monthly basis. So it's way cheaper right now to afford a home on a monthly basis if we're pricing it in S&P 500 stock. Well, if you say, hey, Voltaire, look at, man, I get it. That's kind of weird, but we're paying US dollars. Okay, cool. So 51 years ago, the monthly payment, a median monthly payment across the US was $142 a month, which sounds cheap, right? Last year, and this is just principal and interest. We're not talking about taxes, insurance, or anything else, okay? Just principal and interest. Last year, the median price monthly payment across the US was $1,170. But obviously, $1,170 is a lot higher than 142. So, right? But if you add in inflation over the last 51 years of all the inflation that happened, which devalued the dollar, right? And you take all that, if you adjust it for inflation, today it will only be $169 a month. So when you say, man, I wish I could go back in time and, have $142 monthly payment. Well, adjusted with inflation, you're paying $169 a month, median across the US. So these are just, so now if we compare it to commodities, okay, it's super cheap right now, I think. All right. But then when you start factoring in things like we went over, which is hey, inventory, 1,400 homes. How are prices going to drop? I don't think so, right? And then we start talking about construction. Okay, what if they just build a bunch more homes for inventory? Well, Abe just went over those numbers, right? They're not going to build anytime soon as fast as they need to in order to get to the amount that we need to build as far as inventory. Interest rates, Robert Kelly talked about them. They're super low right now, super low. And you're making money if you're borrowing money right now, because if inflation's 6% and you're borrowing it at 3%, you're making money. So there's all these reasons why I think it's a good time to buy real estate. I think it's a good time to borrow real estate. I believe if you have your property paid off, you should consider taking out a loan against it, because at that point you're making money, like we mentioned earlier in the call, right? If you're borrowing at 3%, inflation's at 6%. And especially if you're able to reinvest that money, that profit, and build yourself an ADU or buy yourself another property, and now you're earning 5% return on that property, but you're borrowing it for 3% and inflation's at 6%. And the last thing is appreciation, right? We're up 24% over 12 months. 24. So if somebody owned a $1 million property last year, today it's probably worth $1.24 million, right? So again, there's 6 ways to make money in real estate. There's appreciation. There's the inflation aspect of it. There's tax write-off on, sorry, my Siri picked up. There's tax write-off on the interest that you're borrowing. There's, hold on, I'm having a brain fart. There's inflation, appreciation. There's depreciation on your taxes. There's the tax write-off. There's a principal pay down. So remember, principal pay down is a piggy bank. So if you borrow $1 million and you paid off over 30 years, you're just, it goes from $1 million to 998 to 995 to 994,000 that you owe. So every month you're paying it down. It's a built-in piggy bank, right? So, and then the 6th way to make money off of real estate is the way that everybody else thinks, or the only way to make money, which is rent, right? Once you start renting it down the road, then that's the 6th way to make money. So there's so many ways to make money, especially in this market with inflation going up and interest rates being so low. It's just it's a good time, I think. So don't think like you missed out. There's no FOMO. It's a really good time in real estate. So that's the 2022 forecast. I believe if you own real estate, you're solid. If you do or don't own real estate, you should probably look into buying some more. That's what I'm doing. And I'm very conservative, in case you guys don't know me. And by the way, I forgot to mention this, because you might be like, hey, I don't know you that well. Well, here's my quick resume. I forgot to bring this up. 19 years in the business. I have actually 30 tenants paying me rent. Been investing since 2005. Full-time residential and commercial real estate broker and property manager. And I've done big deals, 11 million, small deals, 50,000, helped hundreds of family, and became a millionaire at the age of 32 through real estate investing, through buying real estate. So I'm betting big this year on real estate. Awesome. Any questions before we wrap this up? I have one from Gio. And back before the crash, you only paid partial interest for a while. Yeah, back before the crash, they're giving out crazy loans where you would pay partial interest or interest only, and those types of loans are for experts, real estate experts only.
Voltaire, the partial interest loans were actually the negative amortization loans.
Right.
Only a few probably 20% of the loans, 10% of the loans had that program at the most. It was more of the limited time teaser rate programs that were fixed for a year, 2 or 3, with really low rates, 1.8, 2.1, and interest only. And then they would go to fully amortized 4, 5, 6% rates, and payments would double, triple, quadruple, and that's what made that mess.
Yeah, yeah.
But it was partial interest. Yeah.
Yeah, there's that definitely did. And you know what? I completely forgot to bring on Jesse, Jesse, if you're out there, he's the tax guy. Okay, so he's gonna tell us different things with tax laws that might affect us if you're a real estate investor, real estate owner, or thinking about doing real estate. So I'm trying to find you on here so I could.
Yeah, man, I'm right next to you on my screen. I don't know.
All right, cool. Hey, what's up? I see you now. All right. So do you have something to share with us, or are you gonna?
This will be fast. I mean, come on, it's like,
Perfect.
who wants to talk tax, right? But I do have a couple of rapid fire things. Can I share my
Yeah.
screen?
Here we go. All right. I always have you on first. I know you were busier earlier because I like to talk taxes first, and then that way everybody. Okay, here we go. All right, here's
Okay.
all right, guys.
So rapid fire.
Get a blanket and pillow.
Right. We talked about this a little bit last year, but it's now the law. Like, whereas it wasn't the law, now it is the law. If you own a home or think you're going to inherit a home, California's Prop 19 is now the law of the land. Okay. The big deal here, if you're a home owner, you kind of won the lottery. Okay. And what I mean by that is previously you could downsize and that was it. And you had a one-time deal after you're 55. Now, if you're 55 years or older, you can trade up or trade down and keep your low tax basis. Okay. If you go up in value, you're only going to pay extra taxes on the difference between the sales price and the purchase price. And just so we're all on the same page, you guys are familiar with Prop 13, right? Prop 13 keeps your property taxes low. Okay. So you could buy a house in 1970 for 70 grand. And it could be worth, $2 million right now. Probably only be paying taxes on like $200,000.
So this is a big deal because people over 55 were like, man, I want to downsize or I want to move, but I can't. I'm stuck because I don't want my prices, my property taxes to go up. And this allows them to move up or move down.
I just did this today. These notes are not notes I did in preparation for the call. This is a real person who bought her house way back when for $320. It's currently being assessed at $607, and she can sell it for $2 million. Okay. If she didn't have Prop 19 and she bought another $2 million home, she's going to go from paying $7,500 a year in taxes to $24,000 a year in taxes. If she could buy another $2 million home right now with Prop 19, and it literally saves her $17,000 a year. It's crazy. Okay. The reason I brought this up is, and this is BOE, like, wherever you are politically, pretty much everybody can agree that we get frustrated when we're dealing with the government. The BOE's got it right. This comparison chart's easy to read, easy to understand if you know what you're looking for. The bottom line is, if you're 55 years or older, anywhere in California, if it's your principal residence, you can sell your property. And if you're going down, equal or lesser, it's the same rules, by the way, 105% the first year, you won't be reassessed. If you go up in value, like let's say in her case, she went up to 2.5. Okay. What's the difference there? Well, the difference there, it's 600,000 what she's being assessed on. Her house is 2 million. She sells it, buys a 2.5. The difference there is $500,000. 600 plus $500,000 is 1.1. So this is still going to save her. She'll be paying $13,000 in taxes instead of $7,500. but I'll pay 13 grand versus 30 every day of the week.
Yeah, 100%.
Okay.
No, that's really good. So for anyone who's over 55 and you have questions about this, we can link you up with Jesse and reach out to us, and you're not stuck, right?
Right. The flip side is you are kind of in a hard pickle if you're going to inherit a property.
Mhm.
If you're 55 or disabled, it's good. If you're inheriting mom and dad's house, oh man, it's not so good. The bottom line is, if it has to be their principal residence and your principal residence.
Mhm.
And if it's not, it gets reassessed. Like it used to be, if your rental was assessed at less than $1 million, you could pass it on and not get it reassessed for property tax. Not so anymore. If it's not your primary and it's not your kid's primary, it's getting reassessed. And if the taxable value is over $1 million, there's additional adjustments. So it's just, what's the learning point here? The learning point is, if you're 55 or older, you can upsize or downsize, and your property tax basis will be protected. And if you inherit a property, the purpose behind this is, if you inherit a property and it doesn't get reassessed, the government's losing out money, in their opinion. Since you're going to inherit that property and it's going to be reassessed, what you're most likely going to do is take advantage of the capital gains tax-free allowance, and you're going to sell it the year that you inherit it. Somebody else will buy it higher value. They'll pay more property taxes, and you'll just have that cash inheritance.
Okay, cool. So that was a big thing last year that became law, or this year, right?
Right. And you asked, what are the new laws?
Yeah.
That's one. Two.
And by the way, someone, before we
Yeah.
lose track, someone did ask if they're, let me see here. If you're a disabled veteran, you are not required to pay property taxes. Is this just for the owner occupied or for all your properties?
That's not 100% true. You have to be really disabled.
Like a certain over a certain percentage.
Like, not like bad.
Yeah.
So when you look at, I think it was.
Well, just so we don't lose, but we could answer his question, I guess, in an email or something.
Yeah,
right?
yeah. I'm saying it's not property taxes, even for disabled veterans. It's not what you think it is. They still pay. This is an article from the Santa Barbara Association of Realtors, saying that 1031 exchanges are safe for now. This is very, very important. You guys have to be aware of this, that one of the talks from the Biden administration about how to pay for all the spending was to eliminate the 1031 exchange loophole. And in this article, he talks about members of the House Ways and Means Committee actually sending letters out to their constituents, I guess, letting them know that the 1031 exchange was safer now. Okay, that's a big deal.
That's huge. And for those of you who don't know, 1031 exchanges, it allows you to exchange a smaller property into a bigger, better property, and to continue doing that without paying taxes over and over. So if you have any capital, if you have any investment properties, you should definitely look into 1031s and join one of our workshops on 1031s, because they're a huge benefit to wealth creation. I didn't even know how they really worked. I mean, I always help my clients do them throughout my career, but once I started doing them myself, I was like, oh my God, I just became a lot richer by trading one property for another property. And then you do it again and you do it again, and then you just accumulate all this wealth. So that's good that it's safe.
Being able to sell real estate and reinvest proceeds into another one that's the 1031 exchange in a nutshell. And it's the most powerful wealth creation tool that real estate investors have. Real quick, for right now, your ability to do a non-deductible IRA and convert it to a Roth still exists. That is one of the things they've been trying to change, and being able to convert your big IRAs into Roth IRAs so you don't have to pay taxes on them later. As of right now, those are still legitimate. Okay. Last couple things I want to leave you with. If you had a student loan that was forgiven last year, normally it'd be taxable income. It's actually not taxable. If you were on unemployment and you had health insurance through an exchange, i.e. covered California. Okay, so you could be on unemployment for 3 months and make $300,000 in your real estate business. So long as you're on unemployment, you'll receive a subsidy to cover the entire cost of the health insurance through the exchange. Okay.
So if you're in unemployment last year,
you're on
you may qualify for the government to pay for your health insurance.
Yeah, if you were, what would you call it? If you received unemployment and you had health insurance through covered California, you're going to get a subsidy to pay for the entire cost of it.
Okay, well, that's good. And by the way, guys, if this isn't benefit you, let's say this information, it might benefit somebody you know, right? So pass along the information, whether it's this or, somebody that you know who's over 55 and feels they're stuck in their home. So this is to make you smarter, to help your friends and family and community.
Right. Now, here's the last one. This is just basically tax planning for real estate agents. Okay. And this is Voltaire, a niche little thing, but it's pretty interesting. 2018, they changed tax code, right? And basically now in your itemized deductions, your state and local taxes were capped at $10,000. Okay. That's been that way for a while. Home loan interest was capped at $750. So, you could, even if you paid $24,000 a year in property taxes and $20,000 a year in real, state income taxes, instead of deducting $44,000, you would be trapped at $10,000. Okay. So what California did through AB 150, they now allow you to make, it's called a pass-through entity elective tax, is through your S corporation, you can make a tax payment equal to 9.3% of your profits, which will be deductible on the federal return, and then a credit given back to you by the state and your personal. The problem with this is if your gross revenues are over $1 million, it will actually cost you more money in taxes. The sweet spot for this are typically going to be single people that make $200,000 to $800,000. When we look at the tax brackets, 200,000 single, 35%, up to about 800,000, and then married somewhere between 330 and again, I'm going to say 800,000. It's because you only get $12,000 as a standard deduction single or 25,000 married. If you're not able to deduct all of your state income taxes on your itemized deduction, this is a really powerful tool. But again, a big word of caution: if you're going to make over $1 million, don't do this. This will absolutely blow up on you.
Yeah, I don't think there's a lot of us on this call that are making. Yeah, so
it just has to be done by March. If you're in a situation where you're limited by the $10,000 limit, you may be able to have this planning opportunity. And think of it this way: you have 300,000 of profit. 10% would be 30,000. So you pay $30,000 in taxes through the S corp to California. That's going to lower your taxable income by 30,000. It might save you $8,000 to $10,000 in federal taxes. And California doesn't care because they're getting paid either way.
Okay, cool.
Hey, and V, to add to that, like you said, you have to do it by March 15th, but that'll just be for the California credit. And if you got any other owners, all the owners need to make the election.
Yeah. Oh, yeah. Let me tell you, Jerry, I'm making this You know, this is not perfect by any means, but it is something.
Yeah,
For sure. Cool.
I like
Thank you.
this.
Yeah, this is cool. Any other information before we wrap up the call?
No, man, I think those are the big things we covered. Prop 19 is real now. It's like, that's the law. And 1031s are safe.
Cool.
Those are and this AB 150, those are the three things I wanted to communicate tonight.
Cool. Well, I appreciate your time. I appreciate you staying up late with us, and everyone who jumped on. You know, if you have any questions, feel free to reach out. If you want information of anyone who jumped on today and presented and want to just, you know, get a consultation, pick their brain, whatever, reach out to us and we will introduce you to them. And one quick questions. Oh, someone asked me about the Airbnb. I mentioned it. I just kind of skipped over it. So San Diego, what they want to do is they want to limit the Airbnbs. They want to turn it into a lottery. So right now, anyone could turn their property into an Airbnb, whether it's a rental or they live in it or whatever. So what they plan to do is allow people who live on the property or part of the property to be able to do Airbnbs compared to investors that buy, 20 properties and turn all of them into Airbnbs. That's like one change they're discussing. The second change they're discussing is make it into a lottery. So you would have to win the lottery in order to turn your property into an Airbnb, compared to now, the way things are right now, is you could just turn any property into your Airbnb. So those changes happen supposedly in July, and you're buying real estate based on Airbnb rents, then, things, might not work out for you when the changes happen, and if they do happen. So I know City of San Diego has been working on something for a while, and it might turn into law later this year. So that's the Airbnb changes that I was mentioning earlier. If you have any other questions about the real estate market and you want to talk, feel free to reach out to us. And we do have 2 workshops a month, by the way. And Jesse, if you want to put your information, someone's asking about your information in there. We have 2 workshops a month. We talk about different topics. The next workshop in 2 weeks, I think we're talking about basically how to budget your way to $1 million. It all starts with the budget. And then we have 1031 workshops. We have investment workshops. I go on one of the investment workshops. I show how I started and how I made my first $1 million with real estate properties, buying one property at a time. And then we have first time buyer workshops. We have all kinds. So I appreciate you guys. Thanks for jumping on, and we will see each other soon. Peace out. Later. Thanks a lot, Jesse. Thanks.
You guys.
Roberto. There's a question for you in the chat, Roberto. I don't know if you got to it.
Yeah, I didn't. It's from Jonathan Lara. So Jonathan, technically what it means is that as long as you can buy with as little as 20% down, not 25. So essentially, if you're buying a property for 600,000, you put 120 grand down, we finance for 80. And as long as the PITI, the principal, interest, tax, and insurance, or the interest, taxes, and insurance is covered by the rents, it's called a 1.0 factor, DSCR. As long as that's covered by rents, essentially, if the property makes $3,000 in rents and your payment is $2,900, then that's all you need to qualify, technically speaking. Okay, you still have to, show your funds for down payment, 6 months of reserves, which is not much. The beautiful thing about that program that most people don't hear about often nowadays is the fact that the program allows you to do interest only. So imagine if you're doing a loan in the 4%, let's just, for easier numbers, let's use 5%, and you have a $400,000 loan amount, then your payment on that $400,000 at 5% is 20 grand a year for interest. So technically, your mortgage payment is $1,666. So even though rates on those programs are higher than in the traditional investment loans, your payment may be lower because they're interest only, or you can make them interest only, okay? These are technically usually 40-year fixed loans, 10 years interest only. So the first 10 years of the mortgage loan is interest only, and then it goes into a fully amortized payment. But I haven't run into any deals right now that we put together where the rent doesn't cover the payment. So it's definitely a great product for those of you that don't show a lot of income, or those of you that don't even want to struggle and want an interest-only product. Definitely the way to go.
Cool. Thank you.
All right.
All right. Have a good night, guys.
You got
Peace
it.
out.
Take care. Bye.
Later.